Hello, this is Gary Schnitke, and this is a 5-minute Farm Doc Daily dealing with what is ECO. ECO is a new product that you have available to you this year if you select RP, RP-HPE, or YP, any one of the combo level products. And again, most farmers in Illinois choose RP. If you select any one of those three farm level products, you have two add-ons available to you. SCO, Supplemental Coverage Option, and ECO, Enhanced Coverage Option. An Enhanced Coverage Option is available to you for the first time this year. ECO provides county-level coverage from 95% or 90% down to 86%. 86% is the place where SCO begins its coverage. ECO can be used with either with or without SCO. And again, SCO will provide coverage from 86%, the ending point of ECO, down to the coverage level offered by the underlying RP or other combo product. You can use ECO whether you choose ARC or PLC. PLC must be chosen if you use SCO. And again, you can use ECO when you choose RP, RP-HPE, and YP. ECO's coverage will mimic that of the underlying RP, RP-HPE, or YP product. Most of you choose RP, so it will have a guarantee increase if you choose to use ECO with RP. SCO, the other county-level product, provides protection from 86% down to the coverage level of the underlying RP or other combo product. To use SCO, you have to choose PLC. If you're considering using ECO and SCO, I would suggest thinking about them as two policies, a county policy and a farm policy. If my example here, you have 80% RP and then use ECO at the 90% and SCO, you don't have coverage from 90% down to 0%. You have county coverage from 90% to 80%, the underlying RP policy, and then farm coverage from 80% to 0%. County coverage is good for general economics, but it doesn't provide you coverage against your farm yields, and it also doesn't provide prevent plant payments. Those prevent plant payments will come with the underlying policy, and if you lower your RP policy from 85 to 80%, you have lowered the prevent plant payment. I'm going to give you an example of RP, and this is going to be using a 456 projected price and a 0.24 volatility. We're going to have a 200 bushel trend-adjusted APH yield, and based on that, our ECO will have a 212 bushel per acre expected yield. That's because it's in McLean County. That 200 bushel APH trend-adjusted will influence the size of the payments. Those two products have a cost of $10.95 for a 90% to 86% coverage level, $29.26 for the 95% coverage level. To give you a feel, here would be RP premiums for enterprise units in McLean County for a 200 trend-adjusted yield, 100 acre enterprise units. You can see that we have an 85% policy with a $22.38 cost, $10.61 for an 80% RP policy. Again, enterprise units. We add SCO to that at the county level. The county level coverage for the 85% RP would have a farmer paid premium of $136. That increases to $639 for the 80% because we're widening the band. The SCO coverage will now provide from 86% to 80%, and as you can see, as you lower the RP coverage level, the SCO cost increase. Again, to that you can add an ECO product, $10.95 for the 90% product, $29.26 for the 95% product. If you're looking at the 90% ECO product for this McLean County example, you will see that it has $36 of payments for coverage levels at 450 and below. In this case, that is below our projected price. So ECO 90%, if our harvest price is below our projected price, we can expect a payment of, or the highest payment will be $36. If we get above that projected price, we will see that payment increase because of the guarantee provision in here. We should expect this policy to make payments roughly 50% of the time. Again, that would have a $10.95 farmer paid premium, and roughly over time, we should expect that to have a $17.21 payout. So you pay $10.95 in. Over time, you would expect to receive, on average, $17.21, and that includes those times when you get zero, and the other times when you might be getting up to close to $36. Gives you a feel that over time you would expect a positive payment. Here is 95% RP policy. Here we would be looking at something like an $81 maximum payment for projected or harvest prices below our projected price, and we would get higher ones if our projected price goes above that. We would expect, given history, a 67% chance of me ECO 95% making a payment. 2/3 of the time there will be a payment. You'll pay $29.26. Over time, this policy would average $45. Obviously, that $29.26 is a pretty high premium. Again, 1/3 of the time you should expect nothing in return, and over time, roughly $45 in return. As you're looking at RP or an ECO, one of the things you will likely come down to is how much of a premium you want to pay. And again, over time, there are risk benefits associated with that product, but there are premium costs as well. You can read more about ECO in FarmDoc Dailies, and those are linked to in the description to this video below.